My name is David Warshaw, certified financial planner at the Wealth Plan LLC, and today we're going to do a deep dive into the AMG Pantheon Private Equity Alternative Investment. So private equity is an alternative investment asset class that I find missing in a lot of people's portfolios, even ones managed by other financial advisors. So this is a presentation or a deck, and we're going to go through this deck together. Let's begin. The first question is, why would I even want private equity to begin with? What's the thesis behind investing in the asset class? Well, there you have it, right? Potential for enhanced returns, diversification, reduced volatility, and basically access to opportunities that are not available in public markets. This is a $9 trillion asset class where you see a lot of big money goes into this asset class. Over, I would say, the last 5 to 10 years, I have seen this asset class become more democratized towards retail investors, which is really exciting. In terms of the opportunity, most businesses in the United States are private. So if you really believe in diversifying, why would you only want to own the ones that are publicly traded? Wouldn't you want to own the ones that are privately held as well? And as you look through history, basically the number of publicly listed stocks has been declining. Companies are staying private longer. So that's a very interesting little factoid. When you look at a fund like this, in this asset class, there is a big dispersion in terms of performance between the best managers, right, and the worst managers. So you really want to invest alongside a sponsor or a general partner, a GP, who has a good track record, who's a large name in the space. So this slide really shows you who AMG Pantheon is as a sponsor, as a money manager. So just like you'd build a diversified portfolio with public stocks where you would invest in, maybe large companies, international companies, smaller companies, you could do the same thing in private equity. There's different sectors, there's different size companies, different geographic regions. So it's a big world in and of itself. This fund is trying to overcome a lot of issues that private equity has just by its very nature. So the first is diversification. So in this fund, you have access to different managers, sectors, stages of the companies, the vintage, and geography. So what do some of these things mean? A vintage year in private equity refers to the year when a private equity fund begins making significant investments. And just like in the wine industry, when the vintage year affects the quality of the wine, in private equity, it influences the fund's performance due to economic conditions at that time. And the vintage year allows, most importantly, investors to compare the performance of different funds based off that vintage year. So this fund is trying to alleviate or mitigate the J curve. So what's the J curve? This is an example of the J curve. And all the J curve is saying, hey, in the early years of the fund's life, the performance isn't there due to all of these different bullet points that you see here, right? And then once you get to years 5 and on, that's when you can start to see better performance numbers. So this fund is trying to mitigate those risks. A big issue with private equity is that it's illiquid. Think about it. If you went and invested in a private business or your own business, once you've spent that money, the money's gone. It's been spent. You're hoping to earn a profit later on. Fortunately, these funds are very large and they allocate a decent amount of the capital to cash. So you could technically ask to get your money out every quarter. You may not get your money out every quarter, but they do free up a certain amount of the fund's value every quarter, typically 5%. And in a traditional private equity structure, there are what's called capital calls, where you'll get notified that you need to provide them more money. But here, you're fully invested up front. There are no future capital calls. So this fund, try to mitigates or overcomes a lot of the traditional challenges that are normally associated with private equity. This is the meat of the presentation. This highlights all the characteristics of AMG Pantheon. So what I like about it is that it's fully diversified by geography and it invests in different sectors. But I want to highlight a little bit more about the investment type and the strategy. When it comes to an investment type, there are 3 different investment types in the world of private equity: primaries, secondaries, and co-investments. Primaries are basically where you're investing capital in newly raised private equity funds managed by experienced investors. Secondaries are where you're buying existing private equity investments from other investors. And co-investments are direct minority investments in companies alongside a lead private equity sponsor. When it comes to strategy, there are three primary strategies in AMG: buyouts, growth equity, and venture. So buyouts are where you acquire a controlling interest in a company, often through leveraged or managed buyouts. Growth equity is where you're investing in established companies with strong growth potential, but you usually have a minority interest in the company. And venture is those early stage companies with high growth potential, high risk, high reward. A great example of that is a show like Shark Tank. And just like primaries, secondaries, or co-investments, each one of these strategies has pros and cons. So what's important with a fund like AMG is you're relying on them as a manager to figure out which types they should go into and the allocation there, and which strategy they should go into and the allocation there. You probably haven't heard of some of these terms before, so let's dig in a bit more. You're going to hear terms a lot: a GP versus an LP. So a GP basically refers to a general partner. The general partner manages the fund. They're the ones in control. They have unlimited liability. They may invest 1 to 5% of their own capital into some of these companies, and they're the ones that are going to get compensated their management fees and carried interest. The limited partner is really me and you, the end-to-end investors. We provide the capital. We have really no control, no say, and our liability is limited to our investment amount. LPs basically provide most of the capital. Our compensation is the returns that we earn. So those are the players here, the GPs and the LPs. So the ultimate question is, how has this fund done? And the answer is it's done exceptionally well. Since inception, it's been up 12.71% against the MSCI World Index of 10.78 per year. Now, that doesn't mean much if it, just came out, but fortunately this fund came out in 2015. And what's really interesting is focusing in on 2022. That year, stocks were down a little over 18%, and the bond market was down a little more than 13%. And in 2022, this fund was up 7.84% after all fees. And that's the power of having an uncorrelated, diversifying investment in your portfolio. One element that is important to know when it comes to private equity investing is that these investments are not marked to market. That means that these investments are not updated to reflect their current market prices. And how could they? These companies are not publicly traded and are therefore not being valued when the market is open. Now, there is an advantage to this and a disadvantage to this. The advantage to this is that this provides more stable valuations, allows companies to focus on long-term value creation instead of just reacting to short-term market changes, and helps investors stay the course because of that reduced volatility. The disadvantage is that investors don't really know at any moment what the true value of the company is that they hold. Pricing can be off and can also lead to investors being skeptical if they believe the valuations were somehow being manipulated. Now, for AMG, they do their own internal valuations as well as bring on external valuation firms. Okay, let's recap. The pros of private equity investing include the potential for equity-like returns that are uncorrelated to traditional markets. It diversifies a passive or index-based portfolio, and it provides exposure to companies not publicly traded. And lastly, it lowers your volatility in the overall portfolio because these investments are not marked to market. So by now you're probably saying, Dave, why doesn't everybody invest in something like this? Well, it's only fair that we highlight some of the downsides of investing in a fund like this. So the cons of private equity investing, specifically in this fund, include higher fees than traditional investments. Alternative investments are more expensive than your traditional mutual funds or ETFs. For AMG Pantheon, the total all-in fee is 2.85% per year. That comprises of 3 underlying fees: AMG's management fee, administrative fees, and the underlying GP fees. Keep in mind that this is still very competitive cost-wise because private equity GPs typically charge a 2% management fee and a 20% fee on profits. This fee has different names, but is commonly referred to as an incentive fee, a performance fee, or carried interest. Now, I totally understand you could see a fund that has that kind of fee, 2.85%, and say, hey, that's a deal breaker. I'm running for the hills, especially if you're used to only investing in low-cost ETFs. But in my professional opinion, I'm okay with someone charging whatever they want as long as they can deliver strong net returns after fees. And as we've seen earlier, AMG has done that in spades. The next disadvantage is that it is illiquid. While AMG does allow you to get your money out every quarter after a one-year soft lock, it is possible that you could become what's called gated, which means you cannot get your full distribution or any distribution out. Fortunately for AMG investors, no one has ever been gated. The next disadvantage, a fund like this has higher investment minimums. AMG requires a minimum initial investment of $50,000. And that is actually low in the world of private equity, which could have minimums of $250,000 or higher. It's only available to accredited investors. The definition of an accredited investor is someone with $1 million net worth, excluding their primary residence, or $200,000 annual income for an individual, or $300,000 gross annual income for a married couple for the last 2 years. It's advisor sold only, meaning that the only way you can purchase this is through working with an advisor like me. And lastly, like any investment, there's obviously a risk of permanent capital loss. In summary, AMG Pantheon is a solid choice for those looking to add private equity exposure to their portfolios. They've been around for 40 years and have delivered exceptional results. If you are not accredited or can't commit $50,000 to one fund, it's okay. In future deep dives, we're going to cover other non-accredited offerings with very low minimums. That's a wrap for today. I hope you found this video educational and helpful. Don't forget to like, comment, and subscribe. Thanks so much for watching, and I'll see you again very soon in a future deep dive. Take care. Bye-bye.